Hey Bowtie Nation, Joseph Hogue with your weekly stock market update Sunday at noon before the week starts with the stocks to watch and the stock market news you need to see. And Nation, investors are falling all over themselves to buy memory stocks like SanDisk, SNDK, up 4,500% in the last year, or cloud providers like Nebius Group, NBIS, up 6 times your money. But a shift is quietly happening that changes the entire AI story, forcing companies to rethink their strategy and creating the single biggest problem for the investment. A problem that has one solution and one stock that is going to benefit. I'll show you what's about to happen and reveal that one stock I'm buying, along with important dates to watch for SpaceX investors and why I'm also going all in on shares of Netflix. But first to that emerging problem in AI, with memory stocks like Micron, ticker MU, up 830% in the past year, and accelerators like Marvell, ticker MRVL, jumping 265% just in the last 6 months. You might think that this picks and shovels infrastructure is the biggest bottleneck in artificial intelligence. That build out of data centers, all the hardware and the software that goes into them, pushing up demand and stock prices. But Nation, that is the old shortage. The new problem, the one I'm going to show you, just cost one company $500 million, its entire annual AI budget in 1 month. It's a problem that could bring the entire AI investing theme down, and just one company is going to solve it, and the stock is trading at a 32% discount to its fair value. The setup to this is that giant $500 million oopsie that I guarantee you lost someone's job. Axios reported last month that an unnamed Fortune 500 company, failing to set limits on employees' AI use, burned through costs of $500 million. That was roughly its entire year's budget blown in a single month. And it is not an isolated incident. Microsoft has been rumored to be cutting back on its AI spend after its engineers were caught spending $2,000 a month each, and Uber has spent its entire year's AI budget in just 3 months. The problem here is at the heart of AI costs and how language models like GPT and Anthropic's Claude make money. Whenever you or a corporate user prompts the AI model or generates a response to it, that cost comes in the form of tokens. The number of tokens used increases with longer prompts, more detailed responses, or just the type of AI model, and a number of other factors. Now, in the race to use AI, companies have thrown the budget out the window. If you can lower costs elsewhere in the company or just boost sales, who cares how much you're spending on tokens to use that AI? And so we got the trend called token maxing, where companies actively encouraged employees to use AI as much as possible. Meta Platforms even set up a leaderboard ranking who was using AI the most, with awards like Session Immortals and Token Legends. The result, in just 30 days, Meta employees burned through over 60 trillion AI tokens, costing hundreds of millions of dollars on the Claude AI model. Needless to say, it didn't take long to see how this can go horribly wrong, with stories like companies burning through their entire annual budgets and just little to show for it. But now that companies are getting frugal with their AI costs, cutting back, it's become the boogeyman that could kill the bull market in AI stocks. And that's because even as data centers and the compute capacity is built out, if customers can't afford to use it, those revenues just won't materialize to justify the booming stock prices in AI. That's the recurring flashback that these stocks keep having, fear that the revenue growth from AI users just isn't going to be there to justify trillions of dollars spent in building out the data centers and the LLM models. So when enterprise users make a sudden 180-degree turn to rationing AI costs, threatening that revenue growth, I start to look for who can solve the coming crisis. And commentary by Databricks CEO Ali Ghodsi shows exactly where to look here. Of course, as an AI agent provider, Ghodsi talked up the boom in agent usage, but was brutally honest about the death of token maxing, pointing to the new need to optimize efficiency in AI token use and the costs. And here's where it gets really interesting, because he reveals that instead of the private closed-source frontier AI models like GPT and Claude, users are shifting as much work as possible to the less expensive open-source models. That's because those frontier closed-source AI models run directly on Anthropic or OpenAI hardware and data centers and through their paid models. But open-source AI can be downloaded directly and run on a company's own servers. And while that might mean higher setup costs for hardware, it can save companies millions of dollars in costs running those AI programs. You're not paying the token costs to GPT or Claude, you're only paying your own hardware and the electricity costs. Open source also comes with the added benefit that You're not locked into any one vendor, and all your data stays in-house. And more importantly here, in that shift to open source models, Godsey specifically points out, saying Chinese models are extremely popular among Databricks customers. And while the Chinese DeepSeek model gets all the news, there is one open source model that stands above all the rest: Alibaba's Qwen, a hybrid thinking customizable framework being used by developers and enterprise customers, and recently surpassed 700 million downloads as the global shift to that lower AI cost expands. In benchmark and third-party tests, Qwen consistently ranks right up there with Claude and GPT, and in recent tests outperforming Claude Opus on 5 benchmarks. Another comparison I found here, Qwen scored nearly as high as GPT and Claude in bug fixes, coding, reviewing, and refactoring, all while saving millions of dollars in costs. Using Claude or GPT in these tests would have cost over 1 million tokens and several $1 million at minimum, but was free using the open source Qwen. While users can download Qwen and run it on their own servers, growth in usage also translates to benefits for Alibaba, most directly hosting it through its cloud division. Alibaba also manages deployments, developments, initial setups, and agents, as well as tools for new Qwen users. Think of Qwen here like a gateway product. Alibaba is just giving away the cow, but is then going to charge users services like milking or pasture if they want it. Beyond all this, Alibaba also benefits from using Qwen across its own e-commerce empire for search, advertising, and sales. Shares of Alibaba rallied to as high as $192 each last year as investors clued into the company's strength in AI. But then geopolitical fears over government oversight, and just an exodus to U.S. hardware stocks has brought it down 44% from that peak into strong value territory. And while we don't see the revenue growth we find with those hot AI trades like Nvidia and Micron, Alibaba is set to deliver double-digit growth this year and next, and I think it could surprise even higher on the upside to adoption to that Qwen model. Our revenue forecasts in Chinese yuan here need to be translated, but 1.13 trillion CNY is equivalent to about $169 billion in sales and $6.82 per share profit forecasted. Now that earnings forecast is especially important, with profits expected higher by almost 70%. This company is leveraging just 10% sales growth into a 70% boom in earnings, and that's expected to continue next year with 11% sales growth levered up to 37% earnings growth to $9.35 in per share profits. And that is where we see this deep value thesis come out. Morningstar data shows Alibaba has traded for an average of 2 times its sales and 20.7 times its earnings over the past 5 years. That's how much investors have been willing to pay for every dollar in sales and dollar in earnings. At a market cap of $257 billion right now, that means investors can buy it for just 1.5 times this year's forecasted sales of $169 billion, or a price of 15.7 times expected earnings, that's $6.82 per share. That is a steep discount to that average over the past 5 years, and I'd say the valuation deserves even a premium given that potential for the AI growth story. But then here, even on that average 2x sales valuation, forecasted 2026 revenue means this should be a $339 billion company, or a stock price 32% higher. On the price to earnings valuation and that 20.7 times 5-year average on this year's expected profit of $6.82, that is $141 per share, also a 32% upside. More likely, what I think happens is we see a surprise upside as that Qwen model starts attracting attention. That could mean investors pile back in and push it to a 2.5 times sales valuation that we saw last year. It would mean a $422 billion market cap, or 64% upside to the stock price. I'm going to reveal the stocks I'm watching this week next, but first, if you haven't yet, please use the special invite link below to join me on the Blossom Investing app and see every stock in my portfolio. It's totally free to use and helps support this channel, so I appreciate that. You'll also be able to join more than 500,000 investors to see what they're talking about in the social feed, so look for that invite link below or just scan the QR code here. Some very important stock updates here. First with SpaceX, ticker SPCX, closed down the last 2 days of the week, now down 17% from its high of $225, but still up 15% from that first day closing price of $161 per share. This stock is trading on huge volume every day, averaging 230 million shares traded as investors and ETFs get a position. At its peak, SpaceX was briefly bigger than Microsoft and Amazon. At $2.4 trillion market cap now, it's still the 6th largest U.S. company and bigger than Tesla, Meta, or Walmart. Now, we are still seeing a lot of buying demand from those ETFs and the mutual funds, adding the shares to track their indexes. Now, that's because understand that as SpaceX gets added to these major market indexes like the Russell and the NASDAQ 100, any mutual fund or ETF that compares its returns to those indexes has to buy SpaceX or it risks underperforming the index. Of course, that's assuming that SpaceX rises and takes the index return higher. And that means over the first 15 trading days at least, as SpaceX is added to these benchmarks, it could mean upwards of $15 billion in buying demand for those shares and a support of the price. Now, I'm preparing an in-depth valuation video, but investors need to be ready for volatility here. Now, regardless of its potential, this is a company generating just $7 billion a year in operational cash flow and losing almost $20 billion in free cash flow after accounting for its capital investments. It's a company for which investors are paying nearly as much as Microsoft, which generates $170 billion a year in operational cash flow and $73 billion in free cash flow. And here, for IPO stocks, just as important as those fundamentals are the lockup and the other dates within that first 6 months. Based on documents filed with the SEC, almost half of the shares bought by insiders and pre-IPO investors are available for sale in the first 90 days. Now, the red bar in the chart here is the remaining locked up shares, so those held by insiders and pre-IPO that cannot be sold yet. After that first 90 days, all the locked up shares will likely be available to sell within the following 90 days, so this represents a big chunk of potential selling that could weigh on the price. That 90 days from the IPO, when about half of those locked up shares are released, takes us to about August 10th, which is also likely to be close to the second quarter earnings release date. Now, this first report is going to be hugely important as that window into a company's performance. In the IPO docs, the Starlink internet service was the only profitable segment last year. It's the big revenue and profit driver, and investors are going to want to see it continue to grow. Investors are also going to want to see growth in that XAI segment. AI is the biggest potential driver here over the next few years, and Musk has announced deals recently, one with Google for nearly $1 billion a year in compute capacity at XAI data centers. This week we could see a rebound week on the share price, and that ETF buying should still be supportive over the next 10 days or so, but I would stay under $200 per share with any new buying at this point. After the first 2 weeks of trading, we could see more weakness as the new ETF buying slows down and as those insider shares are gradually unlocked. I'd be more cautious at least until the late July, early August earnings report. Netflix, ticker NFLX, is now down 36% over the last year and has been a stock that always seems to be too expensive for my taste. It's now in value territory. I was worried last week that Netflix would get drawn into another bidding war for Lionsgate Studios until the company denied those rumors on Wednesday. Lionsgate has a solid catalog of movies and a good production studio, but the merger frenzy in media companies is just getting out of hand. Netflix investors should thank their lucky stars the company lost their bidding war for Warner Brothers, and that Fox announcement it would buy Roku last week. Prices are going up to buy other companies. So far, Netflix has been able to stay out of it, though not really what it wanted, though it is rumored to be interested in buying Sony Pictures. Now, streamers need content, but Netflix has always had that advantage in the less expensive international content, and buying legacy US studios just isn't going to help profitability any. I do like the shares here though. While Netflix has fallen to just 8% share of US TV watch time, that's behind YouTube with 13%, Disney and Fox Roku at 10%, it still leads in streaming subscribers with 27% of that market, well above the next largest competitor, which is Amazon with about 16% of the market. Now, this isn't some sexy AI stock with 30% growth, but it's still expected to post nearly 14% revenue growth this year to $51 billion. That is a solid number for a company in the media industry. And better still, Netflix is leveraging that revenue growth up to 41% earnings growth to $3.59 per share. Now, that is some serious profitability and cost discipline. While the shares have typically been priced so high relative to those fundamentals, it's now in value territory here. At a $325 billion market cap, Netflix now trades for just 6.3 times on a price to this year's sales basis. That is less than half the price to sales valuation it traded at in June of last year. On that price to earnings, the stock trades at just 21 times this year's expected earnings of $3.59 a share. Again, that is a steep discount to the PE ratio of 63 times last June, and 55% discount to the average PE ratio investors have been paying over the last year. And none of this means that the stock is going to rebound immediately, but this is a very good deal on a clear leader in its industry, and I'm loading up. Software stocks got slammed last week after Accenture reported earnings that showed weak bookings growth and a reduced full-year outlook, with its AI projects not yet offsetting losses in traditional consulting and software sales. Accenture was down 23% on the week, dragging nearly the entire industry down with it. Workday, ticker WDAY, lost almost 11%, followed by Salesforce CRM down 8% and ServiceNow down 7%, while Adobe ADBE, Intuit INTU, Autodesk ADSK, and Snowflake SNOW all lost lower single digits. While we did see a brief rally in late May, the last 2 weeks have brought back those fears that AI is going to replace revenue at these software and consulting companies. Looking at a one-year chart, we can see the market consensus for those most at risk. Intuit is the clear loser here, as investors bet that AI can easily perform many of the accounting functions it provides. Besides relative winners Snowflake and Shopify, ticker SHOP, the rest of the pack is bunched more closely around losses of 35 to 50% over the last year. This shows a big fear premium in that group that investors aren't really sure what's going to be hit from that AI shift, so they're just selling everything indiscriminately. And with that, it's helpful to compare fundamentals for growth, profitability, and valuation to find the best deals in the space. Here I'll be using the comparison feature on Seeking Alpha Premium. If you like this and you want to try it, use the link in the description below to try it free for 7 days, and also get an exclusive 25% off on their summer sale. In these stocks, while I do think AI will replace a lot of the software industry, it's not going to happen overnight, and there are some great deals in here for the near-term rebound. On expected revenue and earnings growth, ServiceNow, Shopify, and Snowflake are the clear leaders, with revenue growth between 20 to 28% expected this year. That might be slightly lower than years past, but is still strong sales growth. Profitability muddies the picture here a little because the slower growth companies have been forced to cut costs and improve their margins, while the growers are still investing for that growth. Putting it together in valuations, though, it's again clear that the market sees two groups here. The first group, Adobe, Autodesk, Intuit, Salesforce, and Workday, are all slower growth and a greater risk to AI disruption, as evidenced by those adjusted price to earnings to growth ratios, much cheaper than the rest of the group. Of these in this group, I think Salesforce, ticker CRM, is the better and the safer deal, with shares trading for just 17 times earnings, and the company's larger size really giving it some financial firepower to integrate AI rather than be killed by it. Among the other group here, the leaders, ServiceNow, Shopify, and Snowflake, the market still sees competitive advantages and relative growth versus that AI threat with higher valuations. In these, I hold positions in both ServiceNow and Shopify, but would also consider picking up shares of Snowflake. Updating our stock market outlook for this week, we will see the important personal consumption expenditures, that PCE measure of inflation, on Thursday, with the market expecting prices rose 3.8% from last year to May, and similar to what we saw reported in the prior month. But even as the market looks past some of those recent inflation reports to potentially lower energy costs after that Iran deal, that is still nearly twice the target rate of price increases set by the Fed, and the central bank made it painfully clear last week that with still a healthy jobs market, the possibility of raising rates later this year is rising. 9 of the 19 Fed members now see a rate hike by the end of the year, with some even pushing for multiple increases. Chair Warsh himself came out unexpectedly hawkish, saying the central bank is unambiguously and unanimously committed to bringing inflation back to the Fed's 2% target. Now that caused stocks to crumble on Wednesday, with the S&P 500 losing more than 1% and the worst first day for a Fed chair since 1994. But here, I think Warsh is setting up for a giant rug pull on rates that's going to be hugely supportive for stocks in the future. The stock market has now priced in some of those rate hikes this year. The CME Fed Watch tool, which uses interest rate futures prices to estimate any Fed rate moves, shows a 73% chance of a rate hike at the September meeting, and a 54% chance of 2 or more hikes by December. Right now, that is a giant weight on investor sentiment and stock prices, that expectation for those higher interest rates. But here, and this is the important part, while Chair Warsh can't outright control voting by the other Fed members, he has a lot of control over policy direction, and nobody on that board wants to raise rates without a very, very good reason. President Trump hounded Chair Powell for years on lower interest rates, and it cost Fed Governor Cook $1.3 million to defend herself in courts when the government went after her. And while the president has talked up the Fed's independence lately, there's no doubt he still wants to see those rates lower. And I think Warsh is going to do everything imaginable to delay, avoid, and just moved the goalposts on that rate hike. That means when we do get to those Fed meetings in September, October, and December, and the bank votes not to raise rates, it's going to be the market surprise that pushes stocks higher. Join me on the Blossom Investing app, free with the special invite link in the description. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.